Hey, I'm Mitch Goldberg. Thanks so much for joining me. We are just getting started a little bit later than I normally would like to get started, but that's okay. Couple of things to go over in this market and make a couple of points. This is going to be a short live stream today, but welcome to Be the Boss of Your Money. The show is about taking control of your money, of your personal finance. There's a lot of things that you cannot control, but there are some things that you can definitely control. You don't have to control everything. Just a few things to make your dollars work for you to make sure you're in charge. It's very easy to lose control of your money, for your money to take control of you, to be the boss of you. So that's why I call the show Be the Boss of Your Money. I want to go into a couple of things because today about the stock market. Today was a really ugly day in the market. Not that it was down so much. It's just the way the market closed. That we had a nice up day follow through from Friday's big rally, Dow up about 350, only to be down on the day. While you're watching, give us a thumbs up. I appreciate it. Stacy, I see you. Thank you so much for your support. Give us a heart, a thumbs up, an applause, depending on which social media platform you're watching on. If you have any questions, hit me up in the comments. I love hearing from you. It's by far the best part about doing this, answering your questions. And let's just do a quick roll of the intro. We'll get into a couple of things. We'll get out. And I just want to send everyone, including myself, on our merry way. So here's the intro, and let's go. All right. Thank you for joining me. We are just getting started. You haven't missed anything. We're actually getting started a little bit later than usual today. Pete, good to see you, my brother. Thank you very much. Great to see you. So, you know, just what we should know about bear markets is exactly this. Bear markets are very humbling. And every time there's a bear market, and I've lived through a bunch of them, and I've been humbled myself many times, which is why hubris has left me. Not to say I'm not ambitious, not to say I'm not confident, but hubris is a whole other thing, a whole other animal, a whole other sin or emotion, whatever you want to call it. I would say arrogance is the kind of hubris I'm talking about. But you take a look at an individual stock like a Roku or a Facebook or a Netflix, or even if you take a look at like a Clorox, General Motors, Southwest Airlines. So I don't want to just pick on pandemic stocks or tech stocks. It's in every sector. You take a look what happened recently with uh, with oil stocks. It's very, very humbling, and that's why for most people it makes sense to just put your money into a diversified mutual fund, an index fund, if you will, and just leave it. Now you can't invest directly into an index, but you could invest directly into a fund that tracks or mimics an index. But you leave it alone, and just it's just easier to do that than to worry about which stock to buy, which stock to sell, to figure out where the sector rotation is going. One day investors are buying bank stocks, the next day they're selling bank stocks, and they're putting that money into industrial stocks, and then they're selling industrial stocks, and they're putting that money into consumer staple stocks. Consumer staple stocks are companies that make things that you eat, that you need, like cereal, for example. Not to say that only companies that make things you eat are all, consumer staples. For example, Chipotle and Starbucks are consumer discretionary. Restaurants are typically considered discretionary. So that's besides the point. But it's a humbling market when you see the Dow up like 350 and it closed today down 215. So you're talking about a 565 point swing from peak to trough. You know, it's a humbling experience for a lot of people. A lot of people get confused or they get scared. They say, "What happened? Everything was up, and everything's down. How could things change so quickly from 10 in the morning till 4 in the afternoon?" And that's what I mean by humbling. And then you take a look at stocks that go down, and for a year and a half, all you heard from people is buy the dip. Every time a stock went down, you bought the dip, you buy the dip, and you buy the dip again because the situation was lower interest rates, more Fed stimulus, more bond buying, more liquidity pumped into the economy, more people getting stimulus checks having nothing to do but trade stocks on Robinhood. I'm not saying everybody. I'm talking about the younger cohort, not people with families. I'm talking the younger set. Okay. I don't want this to be like I'm picking on the younger cohort. I'm just saying this is where the market activity came from, and stocks were up on the right set of circumstances. The circumstances have changed, and I don't think a lot of people realize that. So they keep going back to what worked yesterday, what worked last year. This is why we use that expression in the stock market. The generals are always fighting the last war, because that means investors keep going back to the same stocks that made the money in the last bull market, when we know that once everything craters, the new stocks that come back in a new bull market are often different than the ones from the last bull market. So it's a humbling experience to see a stock go down every day, see the market go down every day, and finally see the market turn around. And Friday was a big up. There was still a down week last week, but Friday was a really strong day in the stock market. Only to come in today to say, I have to get involved. I better put some money to work. And all of a sudden, everything you bought today is down. And now we're back to worrying about a recession, a hard landing. Is the Fed behind the inflation curveball? Does the Federal Reserve have to raise interest rates more aggressively than what the stock market and what the economy can handle? So we're back to worrying about that again. And that's why you're getting these gyrations. And the market's just going to go back and forth between the Fed is going to stop raising rates and stop cutting back in stimulus, to the Fed has to raise rates because the economy is too strong, because of, well, not that the economy is too strong, but that inflation is too high. So we've got to tamp down demand and just really crush demand, get the price of houses down. If you can't raise the supply of goods and services, then you have to just smash demand in order to get prices down. Smashing demand is hard. It hurts. It causes recessions. It slows business. But that is actually worse. The medicine could be worse than the disease of inflation. Some people say, well, just let inflation go on, because the cure for higher prices is higher prices, meaning that producers will produce more, manufacturers will manufacture more, and the supply side will eventually come up to the demand side, and prices will moderate and then come down, as opposed to just crushing demand, because there's no way supply can catch up with everything that it needs to catch up with now. It's a tough position to be in. I wouldn't want to be a policymaker right now for the Federal Reserve. Actually, I would be, but that's besides the point, right? Let's take a look at how things did. Pop myself up in here. Okay. So the Dow down 215, NASDAQ down almost 1%, down 92, S&P down 32 points. S&P was up about over 1% earlier in the day. Gold barely over 1,700. Oil had a nice little pop, up $4. 10-year yield is barely up, still under 3%. The VIX is up only a little bit, but the VIX came down heavy. That's the VIX. Okay, the volatility index. That's the fear gauge. It was down quite a bit last Friday, and it just popped up a little bit today. Interest rates were mostly higher across the board. A little bit of money coming out of bonds altogether, just a little bit. But if you see the 2-year still at 3.18 and the 10-year at 2.987, that's still a big difference. Okay, so almost 20 basis points. That's still a big difference for the yield curve to be that inverted, for the 2-year to be higher than the 10-year that's inverted. Normally, you'd think the 10-year would be higher than the 2-year. So it's still a pretty steeply inverted yield curve. All right. A couple of questions out there. LinkedIn user. It only says LinkedIn user, so I don't see your name. If you want to hit me back and just say your name, I'd love to say hello. If not, that's okay. You could just be, Mr. LinkedIn user. Mitch, with many commodities down or even trading on their year lows, is it a signal that inflation might begin to slow down? Well, I want to say thank you for your question. The answer is yes. And that actually is something we spoke about in one of our episodes 2 weeks ago. I went over base metals, industrial metals, lumber, food prices, like wheat, things like that. Prices are down. Prices are down on the year. Prices are down substantially on the year. We didn't see it in the last inflation report because it just takes time for uh, these lower price goods to move through the system. But they are moving through the system. And that's what I've been saying. We've already seen peak inflation, and you're going to start to see inflation reports start trending lower. Not that we're going back to the prices we had pre pandemic, but at least from where they are now, prices should start to moderate to maybe only going up. Well, let's say the Fed would like to see things go up only 2% from here. But yes, inflation has peaked and raw materials prices are actually down in the year. When I tell that to people, like, but how could everything be up in price? Because it takes time for the lower price commodities to be worked into the manufacturing process, the system. Okay. So good question. Love you too, Jess. Hi there. Okay. Jesse says hi. So that's where we are. Let's take a look at which sectors did the best. Hold on. All right. Energy had a pretty decent day today. Oil was up, obviously, so that makes sense. Consumer discretionary is barely up. Building materials barely up, but everything else was down. It was generally a down day. I mean, you could tell by the trading that almost every stock was down. It's just one of those days. I'm not reading too much into it. It's just that this is real estate down, utilities were down, healthcare was down, the worst performing sector. This is just the way it's going to be. We are going to go back and forth between not going into a recession and going into a recession. And every time we have a thought that takes over of one way or the other, stocks are going to fluctuate up and down like this. This is really, in my opinion, to be expected. So IBM reported after the close, and the stock is down over $5, and aftermarket trading was down almost $2 today. So IBM is down between today's regular session and aftermarket trading, down about 5%. It's tough to be IBM. I mean, it's like they have been shedding their empty calories for so long, non-core businesses for so long, shedding businesses that they weren't making any money from, just money in, money out, but no profit margin. And they just can't seem to catch a break. But if you couldn't catch a break in the last 10 years, why do you think we're going to catch a break now in the next year, probably in a recession or heading into one? I think we're already in one, but that's besides the point. So that's the story. All right. We are, the market's very humbling. And people think, oh, stocks are down enough, they can't go down anymore. As long as people are saying that, stocks will continue to come down because it's an indication that investors are still holding on to stocks. All right, that's what that means. I saw this in 2000 and 2008. Just stocks went down endlessly, and you thought you had a good stock, and it goes down even more and more. And when you think you can't go down any lower, it goes down more, and it just crushes you. And then you think that's it; it can't go any lower. It's below book value, or it's got a low PE, and it just goes down more and more and more. By the way, a lot of companies with low PE ratios, like the home builders, one of the reasons they have a low PE ratio is because earnings are expected to go down. So if a company has, let's say, a 4 multiple, you know, earnings are down enough, that 4 multiple could quickly become 10, 20, or 30 times earnings. So low PE stocks are often more, I think, value traps than values. That's the way I see it. And I'm going to let you go now. I will be back. I should be back Wednesday, tomorrow. I'm supposed to have a doctor's appointment at 4 o'clock. It's the only one I could get for my shoulder, my left shoulder. I have an impingement and maybe some calcium in the joint. It hurts so bad just moving my arm. I'm expecting I'll be getting an injection of cortisone tomorrow. And I actually can't wait because it really hurts when I work out also. All right. Talk to you guys Wednesday. Have a great day. Bye.